So when you find yourself with a business that is consistent, solid, recurring or reoccurring revenues, John, those businesses can trade double and triple what a business that has one-time revenue.
This podcast is brought to you by Fast Slow Motion, a team of expert consultants that have helped hundreds of growing businesses build scalable systems on the HubSpot and Salesforce platforms. To learn more, visit fastslowmotion.com. Welcome to the Fast Slow Motion podcast, where we teach you how to build a business you love while enjoying your life. I'm your host, Sam Donaghey, and today we're joined by two remarkable individuals whose combined expertise spans the worlds of entrepreneurship, investment banking, and business operations. We've got Zane Tarence, and Zane is a partner and managing director of Founders Advisors. They're a merger and acquisition firm serving middle market companies in a wide variety of industries, which has orchestrated more than 80 tech-related deals with institutional buyers. Zane himself has founded and sold 2 successful technology businesses and brings that unique perspective to his investment banking practice. In addition, he is the founder of, excuse my British accent, Silicon Y'all, software as a service and internet summit, where successful owners and professional investors share insights, best practices, and Southern hospitality. Zane is also the author of a book called 17 Reasons Your Company is Not Investment Grade and What to Do About It. You can find resources for that at www.17-reasons.com. In today's episode, we'll dive deep into some of those reasons you'll find in the book. We're also joined by John Burdett. He's the founder of Fast Slow Motion, a company that has helped nearly 1,000 business owners create transformational change by implementing scalable business operations built on platforms such as Salesforce and HubSpot. So John, Zane, thanks so much to both of you for being here today.
Awesome, Sam. Thank you very much. And Zane, thank you for joining us. And we look forward to learning a lot from you. You and I have been friends for over 20 plus years now. So it means we're both getting pretty old, I think is what that means. But we've been through a lot together. Zane's seen me at my worst and seen me mature and grow, and has been a good mentor and friend. So thank you for that, first and foremost, Zane. And I look forward to our audience learning a lot from you, just like I've learned a lot from you over those 20 years. So you have an awesome story, to say the least. I'd love for them to just maybe hear your story of coming out of school, going to IBM, starting a company, and like, how in the world did you end up in investment banking, and why are you passionate about helping businesses like you do?
John, thank you. First of all, thank you for our friendship. I was looking today, 22 years that I've known you. I think I met you. I have to do the math. I figure out your age, but I think you were 25. And what you taught me in processes and systems and the scalability that, processes give you, then with awesome people, what you can create. That's what I've learned from you. And I'm so grateful. So thank you for letting me be on this. So just very quickly about my background. I have a strange background. I shouldn't really be an investment banker. Some people still say I'm an imposter, but I think I have a unique view of it. Went to school at Auburn, started co-oping with IBM. Stayed with IBM for 12 years. When I graduated, I started with IBM. I love that business. My twin daughters, that are 26, really don't know much about who IBM is. But back in the old days, I think they really created the computing industry, the IT industry. Learned so much about being with a big company, but I had the opportunity to take a product that we had built at IBM when I was with IBM Global Services, started a business called Virtual Learning Technologies, ran that business for 3 years, had built a product at IBM for Federal Express to do web-based testing. Again, you're like, web-based testing, that's no big deal. Well, in 1995, when the web browser had just really come out, I guess in 1994, we just built a way to take an assessment or a survey online versus getting that number 2 pencil that we used to circle the dots. So we invented that. IBM gave that to me, deeded it over to us, and let us become really an entrepreneur. They ended up funding my business. And 3 years into it, I'd learned so much. John, and my ability to manage developers is not really that good. We ended up having 45 software developers We ended up getting a patent on web-based testing. My investors came in one day and said, Zane, you're not a very good operator. You need to sell this business. I didn't know what an investment banker was, but they invited one there, and Chip Porter, to our board meeting. Ended up doing a process, selling the business. And John and Sam, I thought, I missed my call. I had no idea this beyond the bank market existed until I went on a physical roadshow with my banker, showing all these companies our business. We ended up getting 5 offers, 3 from publicly traded companies, 2 from private equity groups. We sold it to Hope Mifflin, and that was in 2000. I worked with them for a year, and I didn't really want to move to Boston, but we made our earn-out. John, you know about these earn-out deals, and left on good terms with them. But then I started a VC model incubator. And this is where I met John. The company John was working with, CTS, we jumped over to kind of continue to help grow that business. I was kind of the business development person, also looking at commercialization. Worked there with John, I had a wonderful time. And then I still had an incubator, a venture capital model incubator that I started to help software companies grow. We were kind of doing that within CTS. And then CTS kind of outgrew me, did a fantastic job. John and the team ended up doing a deal there. And I started with this bank, Founders Advisors, 18 years ago. I was on the board when my partner, Dwayne, started it. But he said, man, why don't you come over and be a river guide for other entrepreneurs? And John, I said, man, I didn't go to Harvard or Yale or Princeton. I don't know if I'm really qualified to do that. He said, man, I think you'd be a good river guide because you are an entrepreneur. You've raised a lot of capital. You've done a few deals. Come over. And then at that time, John and Sam came over here, had the time of my life. A lot of smart bankers. I'm kind of Uncle Zane, the guy that sits on the operator side of the table. I understand what it takes to build an exceptional company, but we get to work with entrepreneurs now to help them, find the right capital sources along the journey to make sure they can achieve their vision. So I hope I didn't go too long, but I think I have a unique perspective as an operator first, but then I've been heavily in the deal business really for 20 years when I was a VC model incubator operator as well. So that's where I find myself nowadays. And what I love to do today in my life is really just serve owners to try to make the journey of entrepreneurship more fun, but also give them information. I always believe entrepreneurs are at an information disadvantage when it comes to the capital markets. So that's my background, and that's a little bit of the way I see the world.
Yeah, I love that. Knowing you so well now, I mean, it's like God built you to do this role today, and He prepared you for that. And we talk about it a lot at Fast Slow Motion. Is work is a good thing. Work is fun, and you shouldn't have to sacrifice enjoying life as part of work. And when you're doing what you're called to do, you can find good ways to make a lot of money, which is a lot of fun. It's not fun to not make money, and there's nothing wrong with making money, but you also get to do what you're called to do, which is a blessing in itself. And then it never really even feels like work. You just get to.
Well said.
Yeah.
Well said.
So let's flip over to your book, because I want to spend a lot of time here. First and foremost, I love your book. I think it's a must read for any business owner or entrepreneur, whether you want to sell your company or not. It's about really building a real business that you love and creates a lot of value. And if you want to keep it, you're gonna get all the dividends from that. And if you want to sell it one day, you can, because the reality is we're all going to exit our business one day. Some of us will choose to, and some of us won't. But you're either going to die in the business, or you're going to go out of business. You're going to sell your business, or you're going to transfer the business to the next generation. Whatever happens there. But I love in the introduction of your book, you use a phrase called own on purpose, OWNON purpose. Where did that come from, and tell us what that really means?
And John, thank you for noticing that. I don't get a lot of people that pick that up. Own, OWN, purpose. Really, I named it that because I think our businesses, as you mentioned, are truly a gift. They're a blessing. The number of people that you get to interact with, all your stakeholders, your clients, your suppliers, your employees, your bankers, your providers of insurance and services to you. It is an unbelievable opportunity to do this intentionally. And so what I really want to encourage, first of all, myself to do, because I don't know about y'all, but sometimes, I don't hold myself accountable enough for this blessing. I want to own my business and be an investor like I am in a lot of businesses, own, OWN, purpose. Because I do think there's a stewardship element here and what a gift. So really, John, that was just a play on words to say, be intentional. Think about every family I affect every day, every person I affect. It's an unbelievable platform, I think, to be intentional.
So let's get into a couple of the reasons that are highlighted in your book. And once again, highly recommend everybody check it out. It's a great book, and it's one of those things where you can pick chapters and move around and stuff like that. But I highly recommend reading it cover to cover because everything is very, very important. But one of the big ones, and it's your first reason. It's the first chapter, and you spend a lot of time on it. I think it's well over like an hour and a half on Audible. And
Sorry about that, John.
It's filled with nuggets of wisdom along the way, but it's so important, and it seems so obvious, but it's really hard to do in practice. I would say is reason number one: your company lacks recurring revenue, so cash flow is unpredictable. So it's all about predictable cash flow. So tell us a little bit about that and why it's important, and what is predictable revenue, and why do we need to focus on that, no matter what type of business we have.
Yes, and John, thank you for that question. And again, as you said, this is common sense, but I always say my problem is closing the gap between what I know and what I do. When you start talking to institutional investors or buyers or people that value private companies or public companies, this is one of the number one things they focus on. And all these reasons are common sense. I've just pulled them out from, really 24 years of due diligence experience, watching these buyers do due diligence. The quality of your earnings. Nobody wants a business. And you shouldn't want it either as the owner. I shouldn't want it. If I don't have predictable cash flow, if every month I'm praying, Lord, please give me a deal so I can pay payroll. That is a stressful roller coaster. Investors don't want that either. If you listen to earnings calls of public companies, mainly they're talking about how predictable are your revenues. Here's what you said your earnings would be 90 days ago. Here's what you're saying they're going to be. Let's check the predictability, the forecastability of your cash flows. So when you find yourself with a business that is consistent, solid, recurring or reoccurring revenues, John, those businesses can trade double and triple what a business that has one-time revenue. So the one continuum, I would say, if I could draw a continuum, it would be from one-time revenue. If you're a project-based business, now don't worry, like John said, even a construction business, a consulting business that does projects, an investment bank that gets paid on transactions, you can do things to move your one-time revenue a little closer to reoccurring and recurring. But the more you move that down the line, the better business you have, and therefore the more valuable it is. And John, I would just say in this, look around at business models today, just when you're running around town or traveling, look at the number of businesses that are trying to create predictable cash flow. A movie theater selling subscriptions to be able to pick your own seating, to be able to pay $39 a month. You get to see the movie first. You don't have to wait in lines. You can break the line. Thinking of car washes that allow you to, please subscribe to my car wash. I can promise you, John, like you and I were talking last week, a private equity group owns that car wash because they want to get me to sign up to a subscription. John, you and I talk about it a lot with consulting. CaaS, consulting as a service. When you can build yourself into the budgets of the client because you have such product market fit that they need you, that creates a recurring stream of revenue. It makes your business work double or triple what it would be if it wasn't.
Yeah, and it adds value to the client too. Like in our world, we call it consulting as a service. Is they're able to have predictable cash flows and expenses on their side, so it's not time materials and going up and down, and they're not worried about how many hours we're logging. But also, we're able to dedicate the team to them. So the same people are around. They're not having to re-educate different people that are coming on. And so one thing I like to think about when I'm, is get creative around how you can build more predictability in your business revenue without losing your focus or drifting away from your purpose. Because we have this mentality a lot, and you and I have talked about it a million times, is like services companies want to become product companies and product companies want to become services companies. Those are very different business models. and very rarely do you succeed at both. And be true to yourself, who you are and who you want to become, but then find ways to make it more predictable so that we often joke too, it seems like it's so hard for me to make $1 compared to somebody else. When you're feeling that frustration, you need to get creative around how it makes it easier to make $1, and you fulfill your mission, and you keep your employees happy, and you keep those clients happy.
John, I love it. I got to say one more thing. You were actually, I think, the first person I've heard say CaaS, consulting as a service. I've gone all over the country now preaching that, so I should have given you credit. But John, you mentioned a huge point. It's actually better for your clients. They know that they have your team, they have availability. They're not scared that, oh no, I'm going to pick up the phone on a project and spend a ton of money when they need to do something for their business. They need you. They don't need to be worried about spending money. They can budget it. It's actually a wonderful business model for clients. Also, a subscriber will give you continual feedback. It takes the lumps out of the seasonality, and it allows you to make sure as a provider, you're staffing to give them the appropriate things they need at the right time. So I think it's good for all stakeholders, and it just happens to triple the value of your business.
Yeah, that's so good. We could spend all day on that. So let's move on to a couple more because we only have a limited amount of time here. Another reason, it's reason 2 in your book. We're going to skip around here in just a minute, but your company lacks a healthy growth rate and sufficient scale. So it's all about growth. And that's one thing, obviously, we're passionate about here at Fast Slow Motion is helping small businesses become big businesses and helping them grow and scale, most importantly, the right way. So help us understand why growth is important, why it's not a bad thing, it's a good thing, and then why is it so important that you are growing and not just maintain the status quo.
John, I love this because, again, it comes right back at me. There's been certain seasons in my life where, honestly, growth was just hard. And I gave myself a little bit of an excuse to say, it's not growth. And those people that are talking growth at all costs, John, it was really an excuse because healthy people grow, healthy families grow spiritually, we grow, healthy businesses grow, and investors know this. Now, here's the key. Grow how? You grow faster compared to your cohort, to your industry, and to your competitors. So make sure when you're looking at these 17 reasons, you look at them relatively to your cohort. I always use this example. If I enter a CrossFit competition with 28-year-olds or with John, that's 15 probably years younger than me, that's not smart. That's not who I should rate myself with. I'm in the Masters division. I rate myself against 59 to 61-year-olds, right? Same thing here. But if you're not growing as fast as your cohort, if you have publicly traded companies in your space and you don't know how fast they're growing, you're being a fuzzy thinker. So investors look at growth. And here's the 2 things I always say, John, because entrepreneurs say, is it revenue growth, top line, or is it EBITDA or profitability? Those are different things. And we know if you grow really fast as a business, it's going to destroy your income statement, right? So there's a relationship between revenue growth, CAGR, cumulative annual growth rate, and your EBITDA growth, your profitability. What we want to do is see those numbers, John, related to each other, where that there's different rules that you and I talk about all the time. Your space is probably 33, 34. It's where you add your growth margin, percentage growth. That was 10 million last year, 12 million this year, grew 20%. Add that 20% to your EBITDA margin. If that number equals 33%, 34% in your industry, John, you're killing it. In the SaaS industry, that's 40. You could be growing 40% and breaking even. If your unit economics are okay, that's fine because you're grabbing market share, right? So it's balanced growth. It's critical. Investors love it. And if we as entrepreneurs don't have pinpointed, simple, no more than 3 growth strategies every year, we're not being responsible. You can have 1, 2, and make sure your organization knows what that growth strategy is, or it's really just a whim and a thought. It's not affecting anybody. We got to grow. John, I got to say one other thing on this resilience. I'm seeing more and more entrepreneurs, and John, I know this is a safe place, right? People see and say, you get my age, there's a lot of business owners that are my age. And again, I just want to hit this. They start not having the same piss and vinegar. I'm going to use the word to grow. It's like, hey, I've kind of made it. I'm fine financially. Guess what? That's irresponsible to your team. Your team of A players wants to be on a growing, winning team because that equals their opportunity. So I'm going to say to myself and to other people my age, even though you're okay, if you love your people, you will put your company in a position to grow because their family, their opportunity, their development, A players want to grow, depends on you grow. So sorry to get emotional, but I have had so many people my age lately say, I'm fine.
Is there a time frame that you want to see on paper as well, Zane, for how long a company's growing before they are investment grade?
Yeah, it's really just, it's up and down up. And Sam, that's a great question. People say, oh, I had a bad year last year. That's okay. Sometimes my marriage of 36 years has a tough season, but it's up and down up like the stock market. If you draw a regression line through your business, is it up and to the right? So I don't really care the time frame. We really look over 3 years. I just want to see, even though you hit step functions, I want to see that you've got this trajectory of getting better and better.
Did I hear you say correctly that sometimes a sharp shoot of growth is actually not a good sort of an indication that this company's a good investment?
If it gets you unbalanced, here's the key. If you have that sharp growth, Sam, know why. Know what the risks are, how it's going to affect your infrastructure, your staffing. I've seen too many owners, including myself early on, even as a board member, we did this. We were like, oh, we're going so fast. When it really got down to the bottom of it, we didn't know why. That scares investors to death. If you hear a public traded company, the CEO and CFO are on that call, and one of the investors, the hedge fund, says, hey, why did you grow so fast last quarter? If they don't have a really logic-based, data-based answer to that, it's really bad, even if you're growing really fast, because something else could be happening in the background that could ruin your business. So great question. If you're having spikes, know why and know how that ripples through your income statement and your balance sheet.
Yeah, that's so good. Winning and not knowing why is just as dangerous as losing and not knowing why, because you can't repeat it. And and it's interesting in current environment. We came off a period over the last 10 to 15 years with SaaS companies. It was all about growth. You grow at all costs was kind of the mantra. And now that the economy's kind of had some headwinds with it, interest rates going up, inflation, it's kind of a turn back to profitability. And you need both. I mean, you need to grow and have profit, but the mix of those ratios are going to change. But you want to know, like you said, add them together to determine what's the proper growth and profitability rate for your company. For those of you that are interested, there's been an amazing case study with Salesforce here over the last 12 to 18 months. So historically, they've grown 30 to 40% and not had a ton of profit margin, and they've flipped that the other way. Now they're growing at 10% and their profit margin is around 30%.
Hey, John, what happened to their stock?
Oh, and it's through the roof. Yeah, they're paying a dividend now. I mean, it's going, crazy. So, yeah. So, if you're interested in this topic and hearing it from a SaaS publicly traded company, go listen to those earnings call, because it's been a case study on that. And that's more of the environment that we're living in, which is good. So, One thing that came to mind too, a quote from Truett Cathy. He says, "If we focus on getting better, our customers will demand that we get bigger." And that it's all about doing things you're growing for the right reasons. And I love bringing up that's the main reason we want to grow at Fast Slow Motion is we feel like there's more people out there that we can help and serve, that's why we get out of bed in the morning. But equally important, we want to create opportunities for our team members. I want to grow people up to stay and not leave. And if I'm not growing, those great people are going to exit because they're great people and they want to grow and get better.
That's right. And John, I got to hit another point on that, because you said alluded to my three favorite words in this. It's product market fit, service market fit, product market fit. When you achieve that, like Chick-fil-A did, like you guys have, to where you give an amazing value, right, to the stakeholder. Morally, you need to scale. And how many companies have y'all seen, John and Sam, that have a great product, great service, they actually cannot scale to truly deliver this. So I think it's our responsibility when you hit that product market fit to be able to scale, and the market will draw you. The market will pull you toward growth. And if you can't do that, it's very, very sad.
Zane, John, this has been such a great conversation so far, and you've given us so much wisdom about how to build a strong investment-grade business. So we look forward to diving into the rest of it with both of you. To our listeners, be sure to tune in to part 2 of our conversation with Zane, and remember to subscribe to the podcast on your favorite podcast platform, or you can find archived episodes at fastslowmotion.com/podcast.